Most of you are aware of the latest meme stock surge. The company in Wall Street Bet's crosshairs was none other than Bed Bath & Beyond. Ryan Cohen may potentially face a class action lawsuit due to allegations of his involvement in an alleged scheme to inflate the stock price. We will cover the breakdown from start to finish of the run-up. In other news, GameStop has not reported a profitable quarter since its original run-up in January 2021. They are in the midst of a cash burn and are looking to expand into the NFT marketplace. Welcome to today's video, ladies and gentlemen. My name is Makita with Moskalenko Brothers. In today's video, we're going to go over the rise and fall of Bed Bath & Beyond as well as GameStop and how companies like those two become targets for retail investors for a short squeeze. If that sounds interesting, stick around for the entire video and make sure you short squeeze that like and subscribe button. Without further ado, let's get right into the video. Before we go over the recent events that are going on with Bed Bath & Beyond, Bed Bath & Beyond was brought to the attention of Wall Street Bets when a user did some digging and found out that the company had been reporting losses for the past few quarters. On top of that, they were also in the process of selling off their real estate assets. Even if you did your own due diligence and looked at the company's finances, you would know it was a mess. But a mess does not mean it can't make any money for those who are willing to take the risk. Based on this information, it was determined that Bed Bath & Beyond was a short squeeze target. On January 27, 2021, Wall Street Bets users began buying shares of Bed Bath & Beyond in an attempt to drive up the stock price and force a short squeeze. The plan worked, and on January 28th, the stock price rose by over 50%. This prompted a lot of investors to buy the stock, in turn driving up the price even further. However, on January 29th, the stock price began to fall sharply. This was due to a number of factors, including profit taking by investors who had bought the stock at a lower price, and the fact that Bed Bath & Beyond had issued a statement saying they were not aware of any reason why their stock price would be rising so sharply. This caused many investors to sell their shares, driving the stock price down even further. Then in March of 2021, GameStop activist Ryan Cohen disclosed that he owned 7.78 million shares and call options representing 1.67 million shares. From the month of March to August, the stock didn't move that much, but went down until the beginning of August. Bed Bath & Beyond started trending in the WSB thread, and the feeding frenzy began once more. The stock price went from trading around $5 to $30 in a matter of a few days. But as they say, what goes up must come down, which is exactly what happened with Bed Bath & Beyond. Ryan Cohen filed an intent to sell his entire stake in the company, amounting to a total of $178 million, and earned a 56% gain on his initial investment, amounting to a total of $68 million in profit. In turn, the stock price began to fall sharply on September 1st, and by September 3rd, it was trading around $13 per share. This represented a decline of over 50% from its peak just a few days earlier. There are a number of factors that likely contributed to it. First of all, when Ryan Cohen disclosed that he was selling his shares, this caused many other investors to sell their shares as well. This is because they were worried that if Cohen was selling his shares, it must mean that he thought the stock price was going to fall. Second of all, when a stock price rises very sharply in a short amount of time, it's often followed by a sharp decline. This is because many investors who buy the stock at a higher price will sell it as soon as it falls below the price in order to cut their losses. Finally, when a stock price falls sharply, it often triggers stop loss orders. These are orders that investors place with their broker that instruct them to sell the stock if it falls below a certain price. When these orders are triggered, it can cause even more selling pressure, which can push the stock price down further. Greed and fear are what play the biggest part. People see an opportunity to get rich quickly and they get greedy by purchasing overpriced shares. Then when the price of the stock starts declining, the fear sets in and they sell their shares to cut their losses. Now, as a result of this, Ryan Cohen and the CFO of Bed Bath & Beyond, Gustavo Arnal, are being accused of stock price manipulation. Gustavo Arnal unfortunately passed away on Friday. His death is ruled a suicide as he jumped from the skyscraper in New York known as the Jenga Tower. Right now, it is hard to say whether or not this class action lawsuit has any legs, but there are allegations that they conspired and inflated sales and profitability to manipulate the stock price. An article on Benzinger wrote, Cohen conspired with Arnal, JP Morgan Chase, and others from March through August of this year to conduct a fraudulent scheme to inflate the price of Bed Bath & Beyond artificially. More specifically, with JPM's support and complicity, Cohen, Gustavo, and others misrepresented the worth and profitability of Bed Bath & Beyond, enabling the company to declare fake sales. The lead plaintiff in this case, Peng Cheng Si, and her spouse said that they purchased 8,020 shares at fraudulently inflated prices. They have incurred a total loss of about $106,000 as the value increased over time due to the alleged deceptions committed by certain individuals who are thought to be involved. The interesting thing to note is that this also happened with GameStop when Ryan Cohen started buying shares and got on the board. There were allegations of fraud and manipulation, but nothing concrete has come out of it yet. The defendants in this case have not commented publicly on the lawsuit at the time, but it will be interesting to see how this plays out and whether or not there was any fraud or manipulation that took place. Only time will tell. Now, about GameStop entering the NFT space. According to Bloomberg, GameStop is in talks with some digital asset companies about the tokenization of certain in-game items. This would allow for the creation of non-fungible tokens or NFTs, which are unique digital assets that can be bought, sold, or traded on the blockchain. This would be a way for GameStop to tap into the growing market for NFTs, which has been booming in the recent months. There would be a number of potential benefits for GameStop if it were to tokenize its in-game items. First of all, it would allow for GameStop to create a new revenue stream from its existing assets. Second of all, it would give GameStop a way to engage with its customers in a new and exciting way. And finally, it would allow for GameStop to tap into the growing market for NFTs. However, there are also a number of risks associated with this move. It is unclear whether or not there is currently a market for NFTs of in-game items. There is a risk that the value of GameStop's tokens could fluctuate wildly depending on the success of the NFT market. And finally, there is a risk that GameStop could alienate its customer base if it were to move too aggressively into the world of NFTs. Overall, it remains to be seen whether or not this is a good move for GameStop. Ryan Cohen currently owns 9.1 million shares of GameStop through his holding company RC Ventures, and that amounts to about 12% ownership of the company, making him the largest shareholder. When he joined the board, he treated the company like a startup, and it will be interesting to see where the company could head with his influence. If you are waiting for the next meme stock surge, sure, you can jump in and make a couple of bucks, but you may as well try your luck at the casino because you can get burned pretty bad when you follow the crowd. Oftentimes, the people hyping up a trendy stock are holding at a loss and want people to buy it so the price goes up and they can close their position. The companies that are usually being pumped and dumped are the ones that are not profitable or have messy financials. Retail investors pump the stocks they know Wall Street is shorting. When the retail investors all buy shares of a shorted company, then the shorts are forced to buy the stock at a higher price to cut their losses, further driving up the price of the stock. Unlike some retail investors, hedge funds are making their trades based on facts and logic, not hope and luck. What can you take away from this video and why should you care about any of this? Well, if you are somebody who's looking to start investing your money instead of holding cash to beat inflation, this knowledge can help you out in making informed investment decisions. And for just $8.99 a month, if you sign up today, you can get access to my investment guide by clicking the link in the description. Just kidding, guys, there's plenty of free knowledge out there and you cannot buy a roadmap to picking winning stocks. No matter what gurus might tell you, there is no silver lining. It's crucial that you do your own research and make sure to buy shares of companies you understand and truly believe in. That's gonna wrap up today's video, and if you made it to the end, I'm grateful that you decided it was worth your time. And if you enjoyed the video, it would mean the world if you smashed the like button. If you want to hear more from us, make sure you subscribe as well. Stay safe and stay informed. Until the next one.